Goldman Sachs beats expectations and hikes its dividend 33%. Morgan Stanley's earnings outperform, and so do JP Morgan's. And across the board, these three big banks announced positive surprises in terms of corporate clients being more active for the investment banking and advisory businesses than had been expected once the initial tariff panic died down. So despite all of this, why are these stocks somewhere between down to flattish over the course of today? Well, Wall Street is a little bit cautious about the fact that some of the outperformance at these businesses have come from some of the more volatile revenue lines. Let's start with Goldman Sachs. Equity trading had a record quarter. That's thanks to the broader stock market volatility that we've all been living through. When we take a look at the generally more stable asset management division, revenues were actually down relative to the same time last year. Morgan Stanley saw credit losses that were higher than expected, so analysts have focused on that. And JP Morgan's CEO Jamie Dimon warned that the market isn't through the woods of macro uncertainty yet, and so he remains super focused on risk management, a sentiment echoed by Goldman CEO David Solomon in earnings today. So what could a catalyst for the share prices of the banks be? Bear in mind that they're up somewhere between 10% for Morgan Stanley and 20% for Goldman Sachs and JP Morgan for the year already. And that's because investors have been waiting and sort of pricing in the expectation that there is going to be a global shift towards deregulation in finance, meaning that banks like these will be required to hold less capital, leaving them free to pursue more profitable business lines or to get more cash back to shareholders in the form of dividends. Some of those big regulatory announcements are expected in coming weeks, so we'll keep watching. Come back for more.